Here are 3 ways for you to get into the stock market as a beginner. So many people are not investing because it just sounds too complicated, but I have 3 easy ways for you to get into the stock market, get into the game, and start making money. I'll also give a bonus at the end that has the potential to make you even more money. The number 1 way is through ETFs, which are exchange traded funds. Now, these are basically a group of different companies of different stocks. So let's say that you go to the grocery store and you go to the snack aisle, right? There are chips there, there's candy there, there's, Pop-Tarts, cereal, whatever it might be. That aisle that has all those snacks is the ETF. It is a combination of different companies with similar services. So let's say that you like technology. You might then look into investing in XLK, which includes the top tech stocks, right? Includes Apple, Nvidia, Microsoft, Meta, and some of the other top tech companies right now. Now, each of these ETFs have different allocations in each of these companies, right? So for example, an index fund like XLK might have 20% in Nvidia, 15% in Apple, 10% in Amazon, right? So if you put in $1,000 and that index fund has 20% allocated to Apple, then $200 of your money is going to be put into Apple. That's how index funds work. So whatever the percentage allocations are for that index fund, that's how your money is allocated when you invest into it. And you can easily find these allocations just by looking up the index fund. So it's an amazing vehicle that allows you to invest in multiple companies and lower your risk, as well as spread out the money that you're investing into multiple companies. Now, somebody is of course managing these index funds, meaning these index funds have fees. So what you want to look out for is the expense ratio of the fund. It measures how much money of the fund is used for paying fees to the people running it. So the expense ratio is what you're paying that index fund to manage that whole collection of stocks for you. And this is completely normal. All index funds charge these fees, and I think it's actually better to do it in index funds that already have things chosen out, that already have a companies curated, than actually going out and doing it yourself. Because you might not have as much experience in choosing the companies to put in your portfolio, so you might as well just invest in a fund like this. So it's easier for beginners to just invest in funds like this and see really good returns even after these expense ratios. And these expenses are already included in the returns. So it's not like you're going to have 10-20% returns and then the index fund will take out money from your brokerage account. No, they're already included in the returns. So when you buy it and then you see a 10% return, that 10% return is after those expenses. Another good example is SCHD, and this is a dividend paying ETF. So somebody out there chose a bunch of high paying dividend stocks and put them in this fund for people to buy easily. So of course the people running that fund are going to charge a tiny amount of fee to run it and to choose those stocks, and they're going to allocate money to the certain companies that they think are going to accomplish the goal of the fund, which is to pay high dividends. So that's why the number 1 way to get into the stock market for beginners is through ETFs. If you don't have a brokerage account yet, which is what you need to be able to buy some of these index funds and to buy stocks, then I'll leave a link to my recommended brokers down below. Some top brokers are Fidelity, Vanguard, E-Trade, right? Robinhood. Some people love Robinhood as well.
Hello, beautiful.
The number 2 way is through REITs, which are real estate investment trusts. These allow you to invest in real estate through the stock market. Now, these real estate investment trusts pay massive dividends, and there are some ups and downs to that, which we'll talk about right now. Anyways, let's say that you go to a mall. Let's say you go to a luxury mall, right? More than likely, that mall is going to be owned by a big real estate investment company. A really big one that owns luxury malls is called Simon Property Group. They're a REIT that pays huge dividends. Another example is Healthpeak Properties. They're a healthcare real estate investment trust that invests in medical office properties and a lot of healthcare facilities throughout the US. Equity Residential is another big one that pays a lot of dividends, and they own a diversified portfolio of apartment buildings. If you live somewhere, if you're using a property, you're gonna have to pay rent on it, right? That's exactly what people have to do that use these buildings and properties. So they pay rent to the real estate investment trusts, and that's why they're able to make so much money. So these real estate investment trusts are getting rent every single month by these office buildings, by the people that are using their facilities, their buildings, or living in their apartments, which is amazing, right? They're making a lot of money. But the best part, and why a lot of people invest in REITs, is because they have to pay 90% of profits to their investors. This also gives REITs a lot of tax breaks. So it works for them and it works for investors, which is why people love them. So when you invest in Simon Property Group or any one of the other REITs, all that rent that they're getting, all that profit they're making, 90% of it goes to you. Another category of REITs are storage facilities that generate consistent cash flow. This includes U-Haul, Public Storage, and more. All the storages that they own are actually real estate investment trusts, meaning they have to pay out most of their profits to investors. So they are really great cash cows for investors. So the dividends that we're going to be getting, all the profits that's going to get paid out to us, that's an upside. But there are also downsides. And the biggest downside is that the stock prices for a lot of these REITs don't move that much. They really tend to stay the same and move sideways. They're not going to get some amazing returns that you might see in the tech stocks that don't pay dividends, and you're not going to beat the market with these. But you're going to be getting consistent dividends from these, which can make your portfolio more stable. And some people really like the reliable income they can get through dividends. It becomes a passive source of income. Once you invest a good amount of money into REITs, you can get a lot of money coming in passively without having to do anything else to your account. Oh, and another really steady dividend paying REIT is Iron Mountain. What they do is they'll collect paper from these corporate buildings and they shred it for them. And there's also SLG, which invests in office buildings and shopping centers in New York City. There's a bunch of other REITs out there, but these are some of the best ones that you can look into if you want to start investing in real estate through the stock market. And if you're okay with the steady sideways growth, knowing that you are getting paid a lot through dividends. Now, the best and my most recommended way to get into the stock market for the average person is through the S&P 500. You're basically buying the entire market, the top 500 companies in the US when you invest in the S&P 500. I mean, it's just really hard to beat, and it works for most people, including myself. And you can invest in it through VOO, SPY, IVV, FXAIAX, VFIAX, and there's a bunch of other ones out there, but those are some of the top ones with the lowest expense ratios that most people tend to invest in, including myself. You really can't go wrong with it. Even the most advanced investors tend to invest in this, and a lot of the most popular investors and the most successful investors in our century, like Warren Buffett, actually recommend just investing in this and holding for the long term. And you guys, the market is up over 70% of the time in the long term. So it's a really easy way to just get into the market, keep holding, and just keep making money without doing anything, because the markets will always go up in the long term. I mean, if you look at the history 50, 100 years back, you'll realize that the stock market has survived almost every downturn, every war, every single thing that has happened in history, and still came out at the top as long as you keep holding over the long term. Time in the market beats timing the market. So just because the market drops when you're invested in the S&P 500, that doesn't mean you should sell. Hold it out. Right now, for example, the markets are down a bit, and hey, I see it as an opportunity to buy more, to buy these companies at a discount, because later on, I know historically the markets have always gone up. It's great for the average person, for the beginner that doesn't want to take too much risk. But for those people who are a bit more riskier, I have something for you here. If you truly want to get into the market, you want to take a little bit more risk, but not too much risk, then I recommend checking out some of those top companies in the market. This includes Apple, Amazon, Nvidia, Microsoft. You can actually just look up the top 10 companies in the S&P 500 to find these. And if you really are able to take on a bit more risk, you can look into taking a position in one of these companies. And why I'm telling you to look at the best ones is because these are established companies that are gonna be around for a long time. So if you can handle more ups and downs in your portfolio from the market, then you are a perfect person to be investing in some of these companies. Because Apple isn't going anywhere. They have over 1 billion users, right? Who doesn't have an Apple product nowadays? Facebook is not going anywhere. Meta is not going anywhere because so many people use their social media platforms. Nvidia, the demand for chips is only going up. So if you want to take on more risk, look into some of these companies. They wouldn't be at the top if people didn't have a strong outlook on them. Another important thing that a lot of these top companies have are moats. And it is extremely important for investors to find companies that have these moats. Because if they don't have a moat, then any new startup can come or any other new company can come, replicate their business, replicate their products, replicate their services, and make them go out of business. But moats prevent that. So going back to Apple, they have over 1 billion users. They have 1.5 billion users, and they have products and services that people literally cannot live without. And their products work so good together. I have my iPhone, I have my MacBook, and I don't want to go to any other products because of that, because how seamlessly they work together. That's a moat. Let's talk about Nvidia. As AI grows, as tech grows, more and more of their chips are going to be needed. They are only going to be more in demand, right? That's a strong moat right there. They are one of the first movers in the space. That's why they have shot up so quickly, because in the future, there's going to be even more demand for this stuff. So, people are starting to invest heavily into it now so they can get those returns later. Microsoft also has a great moat. Windows is the #1 software that is used in America by corporations, by gamers, by the average person. Not to mention Excel. Excel is literally used by every corporate company. Going back to Meta and Facebook, they have more active users than literally any other company in the space, which allows them to be one of the top advertisers, which allows them to be one of the top people to go to when it comes to advertising. So they're able to make a lot of money. And there's nobody else that has that many users. That is a strong moat that will allow them to stay in business for a really long time. For these companies, it's a great start to look at the products that you're using, but don't just look at that. You need to understand what these companies' moats are, why they're going to be around for the long term, how they're performing before you are able to take on more risk and invest individually in some of these companies. And if you're not going to do that, if you're not going to put in the time to do that, then it's better to just stick with index funds. Those will be safer for you in the long term and still print you money. And also, just because a company hasn't been doing well for a while, like some of these top companies, sometimes their stocks will take a hit. That doesn't mean that it's still not a good investment, right? Because the companies will always go up and down. But if you are confident, if you have a strong conviction in the company, you understand how it works, you understand its moats, and you know it's going to be around for the long term, then it might still be a good investment. I mean, those are some of the worst ways to get into market. You really want to look at everything. I know that was a lot, so let's do a quick review. So first, we talked about ETFs. These are exchange traded funds, and these are basically a collection of different companies with similar products and services. At number 2, we talked about REITs, which are real estate investment trusts. Now, they are stable and they tend to have very high paying dividends because they have to pay out 90% of their profits to investors, but the downside is that they are stable. There's not too much opportunity when it comes to growth, but they do pay you a lot of money through dividends. Even with that downside of very little growth, it is a great starting point for investors because of those dividends. And number 3, we talked about buying into the entire stock market through the S&P 500, which is the top 500 companies in the US. This would be done through VOO, SPY, IVV, or some of the other ones I listed before. VOO has the lowest expense ratio, so a lot of investors, long-term investors, tend to lean towards that, but SPY actually has more opportunity for covered calls and options trading, which I'll make more videos on later on how to make money through that. And lastly, as a bonus, we talked about investing in some of the top companies in the market to potentially get higher returns if you are able to take on more risk. But wait, here's a double bonus. You can actually use the ETFs you buy to find some of the top performing companies. So it's like a cheat code. The people managing that ETF have already done the homework to find some of the best companies. You can just look at their top ones and see if you want to take positions in those. And you can actually go to sites like EFTDB to actually see the holdings of these ETFs. And you can just pick one of those companies for your portfolio if you want to invest individually in some of those companies. So there you have it. Now, if you still haven't opened a brokerage account to actually be able to invest in all these things I talked about, then I'll leave a link to my top brokers in the description. Check out this video next if you want to discover the easiest thing you can do to start making more money. I truly appreciate every single one of you watching. Make sure to subscribe. Thank you so much and have a great day.